Welcome to the daily update where I'll go over the action in the market for Wednesday, December 18th, and we'll see how things look for Thursday, December 19th. Okay, this weakness that we had been seeing develop, it finally came through in the form of price action in Wednesday's session. Now, when I did the video for Wednesday, I said there's a possibility that maybe we're seeing a sideways correction. Nah, that scenario has pretty much been thrown out the window now. Yeah, everything that was even related to the stock market ended up going down. There was very negative reaction to the idea that the Fed's going to now pause rates, but that even wasn't a total mystery. If you watch the weekly video looking out into January, that's what the market had been anticipating. Now, those numbers change and they'll get more refined as we get closer to the January meeting, but the market was already seeing that. And but then this idea that we're just going to keep going down with interest rates even after Wednesday, even though they cut rates 25 basis points, the idea that they could even consider the idea of not doing that um, just freaked the market out. Now, this was emotionally driven. This was the market reacting to something and like, oh my gosh, I got to get out. Maybe I bought something on margin. Maybe I have some highly leveraged like option positions that decrease in value or futures positions that are leveraged. And so folks had to get out for that reason because this idea that the market was going to automatically go up, and it still might. You can't take the market for granted. And some of the things that we've been seeing under the surface, the growth versus value and discretionary versus staples, that's still holding up. Now, it took a bit of a hit on Wednesday, but it's still hanging in there. There's still a case to be made that now that the weak money has been shaken out of the market, and if, we'll have to see what kind of fallout there is, that we could go up from here. Now we have no confirmation of that. We're down now. We're negative in the short and intermediate term. We're still positive in the long term, but taking a hit there naturally. But we sliced through the 20 and 50-day moving averages. And I think the only thing that really stopped the selling in Wednesday's session was the market had to close. And it probably would have kept going after that. Now we've stabilized a bit in the after hours market. We've slowed down a little bit there. And the Perma Bears, I mean, this is Christmas for them. It came a week early this year. And they're just thinking that this is the beginning of something. And they could be right, 30% of the time, maybe 20% of the time. They're actually right about what they say. But the fact that they're just ringing their bells and declaring Christmas early this year, that's kind of positive for the market. And there's a couple of perma bears that I pay attention to, and they're just giddy with delight right now. What a miserable existence. I just don't understand that to be so negative in the face of positive things going on. But anyway, um, so yeah, we've turned negative now, but we overdid it. My gosh, this is the biggest move that we've seen since last August. And that's when they were, coming in saying we need a 1.5% emergency rate cut, and then another one at the next meeting. And well, that lasted a couple of days, and then we shot up out of that. We want to be on guard, or at least watching for signs of that developing, because some of our indicators, yeah, they're negative, but there's some hope that we're seeing from these things. But we don't have any confirmation based on price. We have to wait for the charts to tell us that we're turning back positive, or if we're going to continue to be more negative. All right. Getting close to the end of 2024 here, but for right now, the SPX Investing Program, which is a program I've developed, it's free. You can go check it out. And I'm going to be locking it down January 1st of 2025. So if you have an interest in this, please go check that out. There's a link that'll take you to the website and to a video. You get immediate access to the videos as they're prepared. And if you have any questions, I have an email address here where you can contact me. Also, the daily video is where I do my focus of analysis and commentary, but I do a number of different weekly videos. And then the supplemental videos, I do those on an as needed basis. They all feed into the daily video. All right, so let's go back and talk about what happened and then look at some charts. We had a pretty flat open. Now, we were positive with the futures, and then about 45 minutes before the market opened, we started to see the futures really coming down, and that took us to a flat open. But then after the open, we got well, we ended up opening at the daily pivot at 6,048 and the unchanged level. And then we were able to get up to R1 at 6060. And then we topped out at R2 at 6070. Okay. That set the high for the day. Then after the open gets dealt with, and that was about when this happened, we settled down and we pretty much chopped sideways at around the R1 level, just waiting to see what the Fed was going to say and do. Then we had the announcement, and they didn't like it right off the bat. There was no contra bounce to this whole thing where prices immediately go one way for a few minutes and then they shift around and go the other way. Nah, we just tanked and kept on tanking. We declined below the daily pivot, the unchanged level, so then we went negative. We got but down below S1 at 6,038, S2 at 6,025, S3 at 6,000. S4 at 5980, and then I ran out of S's to be able to put on here because I don't the calculator I use doesn't go to S5, S6, S19 or whatever it was. Then we started dropping below levels like 5950, 5900. And then we tried to stabilize and we closed around the 5875 level. So yeah, not a pretty day. We were down 2.95% on well above average volume. Now we have turned to negative in the short and intermediate term. We dropped below the 20 period moving average. We dropped below the 50 period moving average. So now we're negative in that regard, but we really overdid it. We've got a long list in the short and intermediate term of indicators here. And Wednesday's story was about the Fed. And they're a little bit concerned about the sticky inflation, the inflation that just won't seem to go away. And they're probably going to pause cutting rates anymore for the foreseeable future. The market didn't like that, even though if you look deeper, you could see that the market was already kind of figuring that. The smart money knows this stuff. It's just the rest of the reaction that had to take place. And then the geopolitical things. And notice I put the Baltic conflict on here between Russia and Germany. They've never had problems before. There's no such thing as World War I or World War II. Okay, we'll just keep an eye on that and see if that develops into something else. Okay, so here is an extra slide just going through the Fed announcement here. They cut rates 25 basis points or a quarter of a percent. That was pretty much a given and was not a surprise. And also Chair Powell had came out and kind of said, we might have to not cut rates for a while here. That wasn't necessarily a surprise either. And so now rates are going to be remaining where they're at, higher for longer. Because the market, some folks in the market just kept thinking we're going to go down, down, down with interest rates. Well, not as of Wednesday. And it was not a unanimous vote. Fed President Hammock, hope he gets some good rest in his backyard, he dissented in favor of leaving the target rate unchanged. So it wasn't, not like a jury where everybody has to vote the same way. And then this kind of freaked out the market too. The summary of economic projections, which is I don't know how long they've been doing this, but we used to not even know about this. This might be a newer thing that the Fed's come out with. They've raised their estimate for PCE and core PCE inflation from where it had been in 2024. They've raised it up into 2025, and they've lowered the unemployment rate. And both of these together are seen as more inflationary. With inflation going up and employment going down, that was causing some real concerns for the market. And then the median estimate for the Fed funds rate, it was bumped to 3.9%, where last September they lowered it to 3.4%. So that's a 0.5% increase. The market didn't like that either. And so you take all of this together, and we saw a pretty intense sell-off. And then I don't know how to read these things, but this was put out by Edward Yardeni. This is kind of a take on the dot plot or scatter chart. I've even taught math, and I like skip that particular section. But this is, you look at this, and somehow that causes some people to freak out. That's kind of the takeaway I get from this. Okay. So some comments. Stocks declined heavily, and then the usual things, the VIX, interest rates, and the dollar went up. We still have a confirmed Hindenburg Omen that doesn't have Wednesday's move in the calculation yet. So we'll have to see because there's a 1 day lag with that chart. And we got a long list here of things that are extreme negative already. The 20 period exponential moving average on the S&P, the Stochc RSI, the Williams percent R, CCI 14 and 20, the stochastics. Those are the usual charts where we just had the Stochc RSI and I believe the stochastics were on here after Tuesday. Now we've got this big old long list. The force index, it already went down and hit the Keltner band. The standard deviation, we went from the +1 channel down to the -3 channel. The percent B, we closed well below the lower Bollinger Band there. The RSI, the short-term RSI based on 9 periods, we've already gotten pretty far away from the 20-period moving average, where 24 hours ago we were above that moving average. And then the 20-period simple moving average study. And I'll show you all the charts for this. Then intermediate term, we have the VIX. The VIX just shot up. And this is kind of reminiscent of what we saw last August when the world was coming to an end. That lasted, what, a day and a half, 2 days or so, and then we just shot up out of that. So be open to that kind of a scenario, but we don't have any confirmation of that yet. Also, the 50 period exponential moving average getting kind of far away there. The advanced decline ratio is getting extreme, and I should the Stochc RSI is on here twice. That doesn't mean it's twice as important. That just means I put it on here twice. The McClellan oscillator, which had already been looking extreme, it's getting even more extreme, the PMO studies, and then the 50 period moving average study on the S&P. And there's a little bit of a change here to the scenario. They did cut rates another 1/4%, and the market's still thinking that there's going to be a soft landing. But now there's going to be a pause in the rate cuts and an increase in the outlook for inflation. And that's what freaked out the market. The dollar was up, interest rates were up. We were at 4.38%, which was already freaking out the market. Now we're almost up to that 4.5% level with the 10-year yield. We're still uninverted with the 10 to the 3 month and the 10 to the 2 year. So we'll be watching those. And I changed this to red here. Sentiment has dropped well below 50. We had been at 52. Now we're at 37. So, and the context is also down. We're also turning negative with our trend, and we're almost getting extreme already with the red line crossing above the green line. And I'll show you that chart as well. And the bias is negative naturally, and I've switched our momentum to negative now. Okay, so the economic reports, these seem kind of trite now. The weekly MBA mortgage applications index down 0.7%. Last week it was up 5.4%. Housing starts weaker than expected, 1.289 million. They expected 1.347 million, and down from the 1.312 million we saw last time. But we actually saw building permits go up. So I guess you have to get the permits before you can start building the house. It came in at 1.505 million, greater than the 1.43 million they had expected, and also up from the 1.419 million that came out last time. Current account balance just showing the government spending even more money, and it was already bad and just spending more. Okay, here are the charts of the applications index where we've been positive, kind of chopping around here, but now we've actually dropped down to negative. Housing starts, and because this is a pretty volatile number, they do a 3 month average and then annually adjust it there. So we're going down with the housing starts and up with the building permits. So they're trying to plan to build a house, but they're not actually going out and starting to build it yet, according to this. And then seeing a bit of a decrease here with the housing starts. Okay, then looking at real investment advice, this is ISM manufacturing, and then comparing it to the annual change of the earnings per share, where we're positive here. And hopefully that will help the manufacturing index actually continue to go up because they tend to go more hand in hand with each other and they're kind of far apart. If we can see the earnings per share continue to go up, the hope is that the ISM manufacturing will go up as well. And I have to blow up this bottom part here. But again, all these charts came out before Wednesday's price action. So the Fed is cut near all-time highs and the bulls liked it. Well, they didn't like it on Wednesday. And it can be a little bumpy going out 1 month. You're only up, in fact, you're down more than up. You're up 45% of the time, down 55% of the time with a negative return. But then the further you go out, the better it looks when the Fed is cutting rates, when we're near all-time highs. Now, this is probably going to change too. You got Peter Berezin. Apparently, he's like a perma Berezin. Okay, and then but most of the folks that are coming out with their targets for a year from now, 6,500 to about the 6,800 range, and that's probably going to adjust after Wednesday's action. Still seeing a lot of folks leaning more towards equities now, according to the commodity traders advising them. And then risk on sentiment hit its high, and I don't like this 2018 stuff because what was the context of when it hit this level in 2018? Was it going up? Was it going down? What was going on at that time? I don't like those comparisons. First, highest price since 39 years ago, lowest price since last week. Yeah, okay, we have to take it in context here. But this is just showing that a lot of folks are in the market right now and they're anticipating it going up, which may have um, fed into this idea of selling on Wednesday. Okay, and then looking at the net long positioning, where we're still seeing most folks in oil, in gold here. Not very many folks are in oil, and we're seeing a bit of a bounce, but a decrease overall that are in copper. And then Fed rate cut path to slow. Well, this chart says they're expecting 3 rate cuts in 2025. Based on what the Fed came out with, they could possibly do 2 now. And the risk appetite, this also may be feeding into the selling that we saw because we're above zero. And then this looks at the different components, whether it's a dividend contribution to the stock going up and the 12-month forward earnings per share and PE ratio. And then the diamond here is the total return. And it's looking the best where you can see diamonds, they don't, well, not the diamonds, the dividends, they don't feed into as much. If you want dividends, you're probably going to use a different alternative. Not always, but there are some good common stocks that pay good dividends. But there's preferred stock, there's interest rates and things like that, where most of the time folks buy stocks because they want to buy low and sell high. They want capital gains, not necessarily dividends. Okay, I didn't spend any time on Twitter. I didn't want to deal with the self-proclaimed geniuses there. And this is a pretty scary looking chart here where we had a flat open. We made it above R1. We got up to R2. That was the high. We kind of danced around a little bit above and below R1. Things really started to slow down. The Fed came out and boom, we just fell down below. We went negative. We dropped below S1, S2, S3, S4. There's probably an S5, 6, 7, 8, 19 here. And we pretty much closed at the low. And as I said, the only reason selling stopped was because the market had to close. It probably could have kept going. But we have stabilized when I looked at the futures. And you can see over here that we're kind of maintaining the unchanged level now. This is still positive though. Even though the blue line came crashing down, the red line crashed down even more, but the blue line's still above the red line. So on an intraday basis, growth is still outperforming value. This is holding up fairly well. The S&P growth to value ratio, going back to the end of November, still looking pretty solid here. Then the end of day chart, everything got smacked. Growth was down more, but it was down less for the mid caps and the small caps, but all red. The middle area here, these are the corresponding ETFs, like SPY would be for the large caps. But you look at this, okay, it came down. Look at the index just falling off a cliff here. But the growth to value ratio holding up, still in an uptrend. Mid caps falling off a cliff with the index. Mid caps growth to value here came down, but still in an uptrend. Came down a little bit with S&P growth to value, still in an uptrend. So this is some under the surface, guy. You think the smart money could be coming in, trying to get rid of the weak money, the people who don't really know what they're doing, and then they're going to come in and buy and just drive this puppy higher while the folks have been taken out of the market that just automatically assumed we were going to go up. And look at the growth to value ratio here. It ticked down less than 1%, but coming off of a very high reading. The discretionary to staples, now discretionary got hit, staples got hit even more. I guess a little bit less here because we came down with the ratio, but overall, this has also been holding up quite well. Came down 3.45% with large cap growth. Our trend has switched over to negative, and you see here the red line just shot up, and it's already getting close to 40. We not only really pay attention to this if the ADX gets above 40, we also pay attention if the red line or the green line get above 40. And they're getting kind of close here at 37.9. But now we've switched over to negative with this chart. And in the short term, we're at 39.2. So in a short term perspective, maybe we've overdone the selling according to this chart. Volume picked up and is above average. Now, this came out before everything happened on Wednesday. You've got folks out there that recommend things and have newsletters and so forth. Yeah, go in and buy. Buy the dips. Yeah, hey, Wednesday will be a great day to buy the dip. And you might just, get into a position and get out of it the same day because your stop loss was already hit. They're still coming in at 3.6 right now. It's a little bit down, but still a very high reading. The Ulcer Index, which is another fear gauge that we look at, really shot up, coming up to its moving average. And the VIX just shot up. This is last August. Remember when that happened? And the world was about ready to end, and the stock market was just going to go to zero. And then we shot up out of that. Now, I'm not saying that's what will happen this time, but we did see something like this last summer. But we don't want to front run this because there may be some more declines that still need to happen. But the idea of shaking the market and having it not being taken for granted and then coming up out of that, that is a possibility. And you look at the growth of value, you look at discretionary to staples, those are still holding up fairly well. And we also saw a real increase here with the VIX of the VIX. When the VIX goes up or down, this goes up or down generally as well. In fact, we went so far up with the VIX at 27, where just 24 hours ago, we were down here in the like 14 range. It's really shooting up, so we might have overdone it here when we use an RSI to measure that. The momentum, which had already been going back up for the VIX, is now really going up, as measured by the MACD. But seasonally, we tend to see the VIX going down. Didn't go down on Wednesday. SKU index still giving a very high reading here. So whatever the market is expecting, according to this indicator, it hasn't finished itself yet. In fact, the SKU index actually went up. And we went up with this fear gauge. We went up with this other fear gauge. So we're seeing some confirmation there. We're still holding up okay with the risk on to risk off ratio. It declined 1.15%, but it has been going up as the large caps or the big high beta stocks, which tend to outperform the market when we're going up, they held up a bit better. We're still looking good here. When we compare large cap growth to small cap growth, large caps to small caps on a ratio basis, we went up 1.39% with this ratio. And we actually declined with the equity put call chart on a daily chart. So we're still going down with the 5-day and we're going down with this longer term 5-day chart. We're also going down with the 10-day chart. Okay, not necessarily what you would expect to see if the smart money is coming in and starting to hedge. They're not hedging. They're taking their hedges off. And then we had a really high reading here with the volatility risk premium, and that just shot down. And we're at the lower end of the band now. So it was anticipating some kind of a big move. And according to this, that move is pretty much ended now. All right. And then we look at a 1-day chart of the advanced decline percent, just a day over day change. Yeah, we overdid it that way. With the advanced decline ratio, we overdid it there. And we're declining with the advanced decline line based on price and volume. Yeah, there's some weakness, but we've been seeing this building up over a period of time. However, we're still above these moving averages, and the moving averages are still going up. And we're seeing a real deterioration here with a real pullback in the new highs and an advancement of the new lows. So our 5-day and 10-day are going down, but it's been going down now for some time. And we were looking a little more positive with accumulation distribution, where we're coming back up to the moving average. Now we're turning back more negative. Ignore the boom indicator here because we're not all that far away from the moving average. It's already suggesting we're extreme with this, and that's just not what we see when we look at this indicator. We're getting extreme with the 19-day advanced decline ratio and still declining with the 39-day advanced decline ratio. So we're getting extreme based on price. We're declining, but not extreme based on volume. And we were seeing some improvement with the Chaikin money flow here, but now we're back to turning negative. But look at this. The Chaikin oscillator, yeah, it declined, but it's not screaming down and getting us an extreme negative reading. It's actually holding up a little bit better. Now, it's still going down, so we have to treat this as negative, but it held up fairly well. We've turned negative, though, with the vortex. The green lines cross below the red line. And we're seeing this gradual tapering off of the NYSE advanced decline line. Well, it just kicked into higher gear on Wednesday, where the S&P had been going sideways. Well, it kind of caught up and then some. And so we're declining with the advanced decline line based on price and volume for the S&P. And I wanted to show this. We're actually dropping negative with the new highs minus the new lows. And this is a 50-day moving average. And I'll show another chart of this. We're still above zero though, but this has been declining. This is a 10-day average of the S&P highs minus the lows, still continuing to come down. That's longer term negative. This is the better looking chart here where we're coming down, but we're still above zero with the new highs, new lows based on 50 periods for the S&P. Then we look at the NYSE dropping below zero here. Then we look at a 5 period moving average of the highs minus the lows across the broad market, also remaining more negative. Going down with the regular NYSE advanced decline line, also going down based on common stock and price. And looking a little more weak here with our advanced decline line studies, declining with the NYSE common stock, S&P, mid caps, and small caps. And declining with the cumulative advanced decline line based on price. The regular advanced decline line is also dropping further below the moving average. And these are the stocks above their 20-period moving average inside the S&P. It's coming in at 8. That means 8% of 503 stocks, which make up the S&P, or what is that, 4 stocks? Something, 4.5. I don't know how you do a half a stock, but like 4 out of the 503 are above their 20-period moving averages. All the other ones have fallen below. So when that happens, we start looking for this. Now, you remember last spring where we got an extreme reading similar to what we're getting right now. And if in a fairly short period of time we can bounce up out of that and get a reading above 70, look at what the S&P did after that. So we don't know if this is finished going down. I mean, you can't go down much more than it already is. I mean, you can get to zero. I mean, all stocks in the S&P could be below their 20-day moving averages. But at some point, this is going to bottom out. Then we'll be watching to see a quick bounce coming up above the 70 level. And that could be positive. We're also getting extreme with those stocks above their 50-day moving average. And we're dropping negative now with those stocks above their 100-day moving average and dropping below 50. And we're just barely above 50. 55.2% of the stocks are still above their 200-day moving average for the S&P. If it drops below 50, that would turn more negative. Not really a lot to see here other than carnage. We dropped below the 50-day moving average and we're above average with volume here. When we look at Tuesday to Wednesday's rate of change, yeah, we probably overdid it. And look what happened here. Now, it doesn't mean we pick a bottom at this point, but sometimes we could get really close to something like that, especially when we see a positive divergence here, where we make a higher low with the indicator and we're still going sideways and then we shoot up out of that. So, yeah, we're negative now. But at the same time, when we're negative, I start looking for positive things. When we're positive, I start looking for negative things just to try to make sure that we're covering as many bases as possible here. We're extreme negative with the 20 and 50 period moving averages. That's just on the S&P itself. We're still declining with the 200 and the Stochk RSI. And these are our usual charts. The Stochk RSI is extreme negative, as is the Williams percent R, CCI 14 and the CCI 20. And we're already extreme. We're just a couple days ago, we were extreme positive with the short-term stochastic, and we're crossing below the midpoint in the intermediate term and declining after being extreme positive in the long short term with the stochastic. We're hitting the lower Keltner band here with the force index and turning negative, seeing some vulnerability to the short-term trend here based on 20 periods, really dropping below these lines. We just sliced through the 20-period simple and exponential moving averages. And we're coming from the top end of the rainbow where we were yesterday to the bottom and actually dropping below the rainbow here after Wednesday. And getting extreme, we already have gotten pretty far away from the 20-period moving average, crossing more negative with the 50-period moving average study and seeing some weakness with the 200. And going from the +1 channel to the -3 channel with our standard deviations chart, suggesting that maybe we overdid it there. We've turned negative with the balance of power. We're turning brown now. That's negative with the go, no-go system, dropping below the midpoint, and we haven't even seen the red line have a chance to catch up to what happened to the price here. And negative, and we've been kind of seeing this trailing off with the TTM squeeze. And now we finally saw that brought out in price. I don't use this as a primary indicator. I know some of you that have contacted me, you love this indicator, and I like it, but I don't love it because we were going up with the S&P here as the TTM was going down. And so I was like, okay, something's got to give here. And so, yeah, this is a useful indicator, but I don't base decisions around it. And we did see a real pickup in the speed of the S&P as it's going down. So standard deviation went up. We're turning negative with the ease of movement. The Arun took a day off. It's unchanged right now. And then it'll kind of probably react later. And we're getting extreme with the McClellan oscillator for the S&P. Now, this could end up being positive. And you look at when we came down and had extreme negative readings, how quite often this happens before we see it based on price. This might be giving us a heads up. But we don't want to front run this, and we don't want to assume this is going to happen. But sometimes when this bottoms and starts to go up, that's before price ends up bottoming. And we saw this was actually a few days before the bottom in price here. Well, we're seeing a similar reading now, but we're still declining with the summation index based on price and volume. We're also getting extreme with the McClellan oscillator for the NYSE. And notice how this bottomed before it bottomed in price? But we're still going down with the summation index based on price and volume. We're still declining with the Swenlin trading oscillator. Momentum is shifted now to negative with the PMO going down. And we actually got a heads up here because these are different indicators, but we crossed below the moving averages based on price and volume. We're getting extreme negative with the PMOs that are rising. We're also extreme with the buy signals. We're declining with the PMOs above zero. Momentum now in the short term has switched to negative. In the more short to intermediate term with the MACD, it's already going down really fast here. So we're negative across the board here, and even some of our long-term oscillators are starting to cross over negative. The copy curve, another momentum oscillator, continues to be negative. We had been up here in this nice little holding up okay area, and we just dropped down more to a neutral area, and that's negative since it's declining with the Sean trend meter. We dropped below 50 with the money flow, and we're continuing to decline with the ultimate oscillator, coming down but still above the moving average with on-balance volume. And this is the percent B indicator. We closed well below the lower Bollinger Band. That tends to not happen very often, and when it does, it tends to not last very long, but it can last a few days. And we need to see either price go back up or the Bollinger Band come down or a combination of the two to work off this extreme reading here. And we're dropping below 50 for the first time in quite a while with the RSI 14. We're already extreme negative with the RSI 9. That's the short-term one. And coming down to this 65-day, I don't know why 65, but this is the Elder's Impulse system, which is a pre-built system. We went from neutral to negative here. Yeah, think? Okay. We're still negative with the parabolic SAR. We're below the red line and the blue line here. The longer we stay below this, that could threaten the intermediate term trend based on 50 periods. And we closed down below the 50 period simple and exponential moving averages, where I wasn't even showing this chart before because we were so far away from it. Well, what a difference a day makes. So we sliced below the 20 moving averages and 50 moving averages. Now, if we continue to fall, we'll be watching the 100s. And we continue to decline, and we've now turned negative with the bullish percent index. We dropped below 50. We're also dropping below 50 with the NYSE bullish percent index. And now, where we just had a reading of 70 after Tuesday, we're actually going negative now after Wednesday with the bullish percent index for the NASDAQ 100. And this seems kind of trite now, where I was pointing this out that maybe one of these lines will act as support. No, I don't think so. We sliced through them quickly. And just to show you this, we have the all-time high that was set with the S&P, so I readjusted these fib retracement levels. I'll probably stop showing this chart after, unless we really scream down more. But we're still far away from these levels. And another thing I was trying to point out is this is a long-term trend line, and maybe this was acting as overhead resistance. We have not been able to comfortably clear above that. And showing the Ichimoku cloud, we're dropping down here. We're actually turning down with the green line. It'll turn more negative if the blue line crosses down below the red line. But when you look at the Ichimoku cloud itself, we're still above it. So this support level is still holding up for right now. Then the different charts, we were kind of chopping along with the Heikin Ashi going from negative to positive. Well, we're now looking more negative. The Keiki chart, which had already turned negative since it turned red and was pointing down, is even more so now. The Renko chart, which had been positive, is now switched over to negative. The three-line break, which had been negative, is even more negative now. And we saw enough selling to put 3 zeros in here, and now we're working off of a high pole warning. Okay, so we'll have to see if that turns into anything more. We are seeing some weakness with the 150 and 200-day simple moving averages. Now, this is something to keep an eye on. This is the SWAG NYSE breadth thrust, and we're getting a really negative reading. Now, notice there's a 1 day lag here. Okay, this came out on the 17th. We just finished the 18th. So this is probably going to go down a lot more with Wednesday's action. But when we get down below this zero point 0.4 level, and then within 10 trading days, we can zip up and get above this red line, that is a very powerful signal. So we'll be watching to see if something like that plays out. And once we finally bottom and start to go up, then that's when the 10-day tick off begins. And we are coming down a little bit with the Zohar check. This is also a day lag here. We came from 10 down to 8, but that happened a couple of days ago. And we're negative in the short term with all the different indexes. We're also negative across the board with commodities and still with bonds based on price in the short and intermediate term. All the sectors ended up being down. It's like if you owned anything related to stock, it got sold on Wednesday. Discretionary, which has been the strongest area, it got hit the most. Healthcare, which has been a weaker area, it got hit the least. And then I drew the red box around here to kind of show these are all the things that happened after the Fed came out with their announcement. And other than the dollar setting a 2 year high, which is negative, you see nothing but blood going up all the way here. A lot of technical damage was done. And we're seeing more damage here when we compare the weighted version with the equal weighted version of the S&P. So the ratio is still going up because the weighted version is still holding up. Now, it was unchanged, but this is holding up for right now, meaning the large caps and the mega caps are still holding the market more together. And we're seeing this ratio going down as the equal weight is underperforming the S&P. And Dow theory is just really getting shot right now. We're going with the Dow and the transports. They're down. And then I include utilities as part of Dow theory, but a traditionalist may not do that. But we've also been seeing weakness in the utilities. And then yesterday I pointed out, you think the Dow will be able to hold out at its 50-day moving average? No. And it also went down below S1 here. And we're dropping down here with the diamonds, with the Elder's Impulse system, coming down, dropping below this R1 pivot point with the NASDAQ. We had been holding out at this R2 pivot point level now. Well, we dropped down below R1 with the NASDAQ 100. We're negative with the Elder's Impulse system for the NASDAQ 100. The momentum not quite crossing below the moving average yet, but it took a real hit with the momentum for the NASDAQ 100. In fact, we closed below the 20-period moving average with the Qs. Small caps, supposed to automatically go up this time of year. Well, they went up, and then we just been trailing off, falling below their 50-day moving average and below these pivot points now. And then the Russell 2000 small caps getting extreme with the RSI falling below the 50-day moving average, and the momentum continues to be negative. And we're going down and negative with the Elder's Impulse system for the small caps. Mid caps also. This 50-period moving average convergence that I brought up in yesterday's video, it's failed to this point. But we'll have to see, was there enough carnage in Wednesday's session that at some point the smart money is going to come back in and say, buy, buy, buy. We're going to drive this market back up. But we did drop down here with the mid caps, and we're negative with the Elder's Impulse system for the mid caps. This is another 50-day moving average I was watching, the bank ETF. Not doing too good right now, but still in a longer term uptrend. And we broke below the 50-day moving average with the financial sector, below the 50-day moving average with the Wilshire 5000, also below the 50-day moving average with the total U.S. stock ETF. Now, this is holding up. I mean, it was down 4.25% with the FANG index, but just coming off of setting a recent all-time high here. And we dropped back down below this short-term trend line, where we're kind of hoping maybe we would be able to stay above that. Not for right now. Apple was down 2.14%. We were down 4.6% with Amazon, down 3.59% with Meta, down 3.76% with Microsoft. We were down 3.59% with Google. Tesla, which had been just screaming to the moon, was down 8.28%. A little bit of profit taking, you think? Nvidia actually held up better. It was down just a mere 1.14%. Yeah, that's kind of interesting. Netflix down 3.22% after being really strong lately. And we're still down to the 200-day moving average here with the SMH semiconductor ETF. When you look at the ETF, this support level is holding. And we're holding up at the higher end of the rainbow with the SMH ETF. Where we're turning more negative is when we look at the SOX index, which is the index for the semiconductors. We are still below the 50 and 200-day moving averages, and we've seen a recent death cross here. And we're back to going down again after seeing a couple of good days with the ratio between semis to tech. And this actually is holding up okay when we compare the semiconductors to the Dow, which also got taken out and shot on Wednesday. And a little bit of a tick up here in the short term when we compare US to world stocks. Longer term, we're also seeing a bit more of an improvement. The dollar, that was the place to be on Wednesday. We're getting up into the 108 range. Going up, we're getting close to that 4.5% with the 10-year yield. We're just falling below the 200-day moving average with the 10-year based on price. I've been pointing this out. We're falling below the 250-day moving average here. When we look at the home construction versus 3 to 7 year bonds and take a ratio, it's still showing more weakness here. We were kind of thinking maybe we would get some support like we got in 2023 or earlier in 2024. Not this time, at least yet. But we're still looking good here with our growth to value ratios. They got hit, but with the Qs to S&P, discretionary to S&P, large cap growth versus value, holding up fairly well. Still looking good with the large caps, mid caps, and small caps, even though they declined. We're still going up with the S&P utilities ratio here. And we're kind of chopping around, coming back up a little bit with the staples to S&P ratio. So what's our outlook for Thursday? We're now negative in the short and intermediate term, but we're oversold. Can you say overreaction? But we don't know how much more it's going to be. Then on Thursday, we're going to get initial jobless claims, continuing claims, the third estimate of GDP, which won't be that big of a deal if the number is pretty much the same. This is the third time we're seeing this number. And then LEI will be coming out, and then all the geopolitical things that seem to have no impact on the market right now. And then in Friday's session is going to be the big core PCE report coming out. And here's a look where we also have existing home sales. I don't have that on the calendar I just showed. Seasonality, nothing really big here. Neutral to positive with the Dow and S&P, neutral to negative with the NASDAQ. But we are in options expiration week where we're up 67% of the time and down 33% of the time. Got some work to do there. And then seeing some seasonality a little bit weaker here before we might see a little bit more positive. It's really later in the month of December where this turns more positive, also for the small caps as well. And Thursday was a good day in 2023, and it's the second best day so far in 2024. This is the positive seasonality that seems to be elusive right now. And then this is comparing the months going after the election since Trump got reelected and how the market's been performing. Of course, this is probably going to come down just a little bit, you think? And then we're coming into the negative time for the 19th and 20th here, according to Tom Bowley's research. But we're supposed to magically be seeing these small caps going up, and they're going down right now. So our smart money indicators are turning back more negative. We were seeing some hope after Tuesday. That hope was vanished on Wednesday. And then the advanced decline lines, we're also looking more negative with the McClellan oscillators and summation indexes, and we're getting some extreme readings. Our momentum oscillators are turning negative, as is the Copic curve. The bullish percent indexes are now negative. We still have a confirmed Hindenburg-Ullman. The vortex is now on the negative slide here. Parabolic SAR is negative, the Swenlin trading oscillator, and now the 20, 50, and 100-day moving average studies are negative. But we're getting a little extreme with the 20 and the 50. The ease of movement, the money flow, and the ultimate oscillator are also negative. And we're just kind of almost on the moving average here with the momentum for the NASDAQ 100. Positive signs. Yeah, we're still going down with the 5 and 10-day equity put call ratios. And growth to value, discretionary to staples are still holding up fairly well. And we're still above 50 with the 200-day moving average study of those stocks inside of the S&P, but it is weakening. The financial sector kind of dealing with its 50-day moving average. It's still positive longer term, but it has been declining and been declining now for a couple of weeks. And we have the Hindenburg Omen here, where this does not take into account Wednesday's session. So we'll see if another spike materializes here. So we just want to pay attention to this. All right, our conclusion. We're negative, but we're oversold. We're supposed to be in a period of positive seasonality any day now. Large caps and growth are holding up, and this 50 period simple moving average convergence across different ETFs and indexes that I was looking at, that's failed to this point. I thought maybe things were coming together and we could bounce up from that. Nope, we've fallen below them. In the short term, we're negative but oversold. In the intermediate term, we're negative and becoming oversold at this point. And in the meantime, we're still seeing the weakness develop. But we're still positive in the long term, even though it's taking a bit of a hit. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.